Morgan Stanley has scored a major victory in the fight to be top banker for stock sales. It has ended JPMorgan Chase's 2-year run as #1. Joining us this morning is a Bloomberg best on Morgan Stanley. He is Douglas Sipkin. He is head of the brokerage and asset management sector at Ticonderoga Securities. It's Monday, everybody. Doug, good to have you here with us.
It's my pleasure.
Hey, listen, let me ask you, how significant is a #1 ranking for Morgan Stanley?
I think it's a positive. I think it reflects two things. One, Morgan's had incredible success working with the government above and beyond any of the other underwriters. And two, I think you're finally starting to see a little bit of the strategy put forth by James Gorman, trying to diversify Morgan away from the trading businesses. So they're pushing to get top ranking in the underwriting franchises.
You mentioned about their involvement in the government issuance, if you will, but that came at a lower fee structure. Is that a good thing or what?
I do think it's a good thing. Obviously, market share comes at a price, but you have to remember doing that amount of issuance is accretive for the trading businesses, which helps, and for bragging rights as you move into 2011 and beyond. To say that you're #1, it carries some weight with clients.
Let me also ask you, because a lot of that was government issuance, as you mentioned. Citigroup was a big deal that
Sure.
Morgan was involved in. That doesn't happen, though, going forward, does it? I mean, that kind of is taken out of the equation. Can Morgan continue this pace and stay #1, you think, going forward?
Well, to be #1 isn't as important, but I do think the outlook for issuance markets are going to remain strong. I think one avenue that people are maybe overlooking is Europe. They're going to be conducting a second round of stress tests, I think, in the first part of 2011. That will likely drive more equity issuance opportunities. Plus, you're seeing some growth here in the United States finally, so the new equity markets can start to pick up. So I still feel pretty good about the equity opportunities for Morgan.
You mentioned about some of the changes going on at Morgan Stanley. I mean, talk to me a little bit about the evolution that's going on and why you think it's becoming a better Morgan Stanley.
Yeah, I mean, it's a process, but they're looking to diversify away from some of the greater risk businesses that got them in trouble in 2007 and 2008. James Gorman, I think, is the perfect executive for that, with a deep history in retail and bringing more annuity-type businesses to the company. It's taking time, but I think the #1 ranking proves that they're starting to have some success.
The stock, though, is down about 7% this year. Compare that with up about 1% for JPMorgan. Not a big move for JPMorgan, but it is up on the year. Why aren't kind of investors acknowledging maybe all these changes?
Well, I think it is still a show-me story. They had a disappointing third quarter for earnings. I still think investors worry a little bit about their capital levels, but I feel pretty good moving into 2011. Rising rates are very good for Morgan Stanley, and I do think that the stock has a real chance to break out next year. What
about compensation? And I bring that up because we've been talking about Goldman Sachs and how they're looking at maybe some different ways in terms of compensation for their employees. How is that going to be kind of impacting firms like Morgan going forward and everybody? Is that going to change it dramatically, change what's going on at these firms?
I don't think it changes things.
And rein in the risk-taking maybe too much?
Well, I think that's already started to happen. I mean, if you take a look at the balance sheets of some of these companies, they've really come in. The reality is reining in compensations net is probably a positive for shareholders, a little less positive for employees, but I do think it's probably a good thing for owners of the stock.
Doug, when we look at these league tables, so we've got Morgan #1 in terms of stock sales, but you look at something like JPMorgan, they're #1 for corporate bond sales. So how does it, I'm thinking about an investor kind of making sense of different league tables. What's the most important?
Well, look, at the end of the day, the most important thing is revenues and earnings. And the firm that does the best in that is going to have the best performing stock price. Look, corporate bond market has been very strong. Odds are it's going to tail off as rates start to move in 2011. So firms that are probably a little bit better positioned than equities probably have a better tailwind moving into next year.
Do you pay much attention to the league tables?
I don't pay that much attention to them, no. I mean, it's nice to see Morgan, given that it's fallen on tougher times the last couple of years, being #1.
Right.
But it's not the biggest deal in the world.
But bottom line, you do like what's going on at Morgan Stanley.
I do. You're starting to see some improvement. The stock is not expensive. Any positive news can go a long way for this name next year.
All right, going to leave it on that note. Hey, Doug, thank you so much.
My pleasure.
We appreciate it. Doug Sipkin joining us on Morgan Stanley.